Good afternoon to everyone. Welcome on board. This is our monthly Bauhaus event. And I would like to underline that this time, I think this event is more important than the others. I mean, without anything, removing anything in terms of importance to the others. But I think this Bauhaus will tackle the key question when we speak about ESG and when we have a real debate in the industry. Do we see correlation between energy efficiency and credit risk? That's the key question that is for the industry, is for the regulators, is for the politicians. In few days, probably Rapporteur Fernandez will present his report on the implementation of Basel III, and the European Banking Authority is working really hard to understand the impact on Pillar 1. So this is not one question, it's the question important for the industry, for the future of the industry. We are all aware that everything changed on the 24th of February, and probably energy efficiency will be the major challenge, but at the same time opportunity for the entire European economy, and how we will reduce the dependency of an external source of gas. It will be the way out for the next crisis. We think that the banking sector will be playing a crucial role, and we are here ready to discuss all together, and we really invite all the participants to take the floor to see together avenues on how we can improve the capacity of the industry to support the renovation wave and to support, I would say, the effort that the European Union will be doing in order to reduce the energy dependency. At the same time, allow me to underline that we want to keep the church in the middle of the village, as the French would say. And it's very important that we keep the ESG debate in a rational environment, and we keep out any form of fanatism that can really trigger some speculative lending or greenwashing. I think that the industry is fully committed to a full transparency, to be aligned with what we have built over the years as banking union, as capital markets union, which was the safe harbor after the crisis of 2007, 2008, and has allowed the financial sector in Europe to be managing very difficult moments like COVID, and to maintain the market open and secure the interest of the European citizens. So by keeping the church in the middle of the village, we would like to present, and I will let maybe Richard to present the speakers, but I would like just to recall that when we started this green journey years ago, together with Jenny, the key question was, there is a correlation or there is not a correlation? Well, at that time, everyone was telling us that we were wrong. There was no negative correlation between energy efficiency and credit risk. And in the meantime, we have discovered that plenty of studies have been produced, all giving the same indication that there is a negative correlation between energy efficiency and credit risk. Of course, we cannot say that there is a causality. That's a different story, but the correlation for sure is there. EDAP was an icebreaker because we have opened a new, I would say, intellectual movement that has demonstrated that there was a correlation. I would like just to praise the excellent work done by several central banks. We have the pleasure today to have the National Bank of Belgium with us. Peter, thank you for being with us, but also the excellent work done by the EFI group, coordinated by Markus, who is really trying to give a strong evidence of what we have been saying in EDAP since years. And I would like to underline that there are no studies demonstrating the opposite. So, I mean, it's true, but I mean, there is nothing saying that this is not true. I mean, there is no academic evidence. With this, Richard, I would like to pass you the ball and allow me to ask you to introduce the speaker of today. Thank you all for being with us.
Good afternoon. Thank you, Luca. I'm going to put my hand up and say that I was one of those skeptics. I think about 5 years ago, I had a conversation with Jenny I think it was in Amsterdam, and we were discussing this, and I thought, no, I don't believe that. Don't believe that it's statistically provable. And I'm very happy to admit that I was wrong. And my skepticism was completely misplaced this time. Luca exactly summarizes it perfectly. If there is a theme to the next 2 hours conversations, it's quite a public sector theme. It's the various bodies, the ECB, the EBA, the European Commission, looking at the work that we've been doing in the last few years and asking how we integrate it. How can you integrate climate risk into a credit risk model? Is the new rulebook, the new CRD rulebook, the right way to address transition assets? How should ESG risks fit into the prudential framework? Does the European Commission actually believe this meta-analysis, this sort of review of all of the studies on this correlation? And first of all, though, what is the impact on house prices? And to discuss that, I'm delighted to introduce Peter Reusens from the National Bank of Belgium, where he's an economist. Peter has been taking the conversation of 1,000 dinner parties about house prices and taking it to the next level to see if we really can prove some kind of correlation between this and house prices. Peter, thank you so much for joining us today. Can I ask you to just present your study and your findings?
Thanks a lot, Richard and Luca, for the kind introduction. Welcome, everybody. So indeed, the first topic is on house prices, so the impact of energy efficiency on Belgian house prices. So first of all, let me start off by briefly explaining why does the National Bank pay close attention to these developments in house prices. Well, house prices, they can really have an important impact on economic activity. Like the bursting of a bubble in house prices can lead to banking crisis and very large recessions, such as what we observed about 15 years ago in the great financial crisis in 2008. This originated in the bursting of a housing bubble in the United States, but also in Europe. The bursting of housing bubbles in Spain and in Ireland, they really slowed down growth in the euro area. Second, and very much relatedly, so the National Bank of Belgium, they are responsible for ensuring financial stability. So mortgage credit has become increasingly more important for banks, and therefore house price developments are also important for banks because they affect the loan-to-value ratio of these mortgages. Then we have also the impact of inflation. So rents already, the cost of paying rent is already included in the standard inflation measures, but very recently the ECB decided to also take into account the owner-occupied housing costs into the inflation measures. This is very new, and in the future this will produce a new measure for inflation that takes into account this owner-occupied housing cost. Now, also an important element of house prices is that they are a determinant of the housing wealth. So if house prices increase, the housing wealth of households, they increase, and National Bank, they produce these statistics on household wealth and housing wealth. And very much related is the housing affordability. If house prices increase, it becomes much less affordable for households to buy these houses. The final element, which is the topic of today, is the energy efficiency. So National Bank of Belgium, they really follow up on this climate change transition and house prices, and the improvement of this energy efficiency to attain these climate goals, they also will affect the house prices, and that's the topic of today. So I will talk about the price premium of energy efficient houses. So we have a new study that we produced and published just last month. This is one of the key results is we produce the price estimates on price premium for Belgium. Then also I will cover the improvement in energy efficiency over the past decade of the Belgian houses that are sold. And finally, I will show you how to take into account these improvements in energy quality in house price indices. So in our study, we were able to merge two key data sets. So we have the transaction data sets, the official of the house price, house transactions, all house transactions in Belgium. And on the other hand, we have these EPC data set, energy performance certificate data sets of the three regions in Belgium. So we merged these data sets together, and this allowed us to assess the impact of energy efficiency on house prices. So we have the transaction of existing dwellings. So we do not take into account the new buildings. And our sample covers the previous decade, as from 2011 until 2021, the second quarter. So the first topic is about the price premium. So how much more do households pay for houses that are more energy efficient? So that is the first key result. Here you can see the graph. So this is a lot of lines, but it's very simple. So this shows you the price premium. So what is the price premium? This is the price differential between an energy efficient house. So the green curves are energy efficient houses, and a less energy efficient house. The benchmark isn't a house with EPC score, so the energy consumption of 250 kilowatt hours per square meter per year. And then you can see for the different lines represent the different EPC scores. So to make this concrete, the green curve over here. So in 2021, the price of an EPC of 150 kilowatt hours per square meter house is about 12% more expensive than the benchmark house of an EPC of 250 square meter. When you go to the very energy inefficient houses, the orange, the red, and the black, you see very large negative values. So price discounts for these energy inefficient houses. And what is very clear here from this graph, so we can see the results from Flanders on the left-hand side, Walloon region, and Brussels capital region, so the 3 regions in Belgium. So the price premium has increased over the past decade. So in 2012, it was only about 7% price premium for this 150, the B label. So this corresponds to a B label in Flanders, but it has increased. It has almost doubled to about 12% in 2021. What do we expect for the future? Well, our study stops in the middle of 2021. So we do not take into account the recent price surges in energy. And also the future regulation, which will imply enforcement or mandatory energy efficient standards, they will likely also widen the gap between the very energy efficient houses and the energy efficient houses. How does our study now compare to the other literature? Well, what I can say is that the estimates of these price premium in the literature, so there is an overview table or graph here of Copiello and Donati. So I just copied their table, and you can see that these estimates, they widely differ. So they range from about 3% to more than 40%. How is that possible? And I give you several explanations for this difference. The first one is the time period. So I showed you before, if you do the estimation of the price premium 10 years ago, you get only half of the price premium compared to today. So the very old studies, they have lower price premium compared to the newer studies. The second is the country under investigation. So this table, they compare the price premium of label A and B compared to label D. So one difference is that the labeling differs. So the definition of this label A and B compared to D differs across the country. And the climate also differs across the country. So depending on the country and the investigation, you get also a different price premium. And the final explanation, which is very important, is the control variable. So this energy efficiency is very correlated with other characteristics, quality characteristics of a house. So a house that is very energy efficient is likely also better or of higher quality in other dimensions. So such as a new kitchen, a very high quality finishing of the house. So these are correlated. So it's hard in these studies to disentangle the pure energy efficiency effects and the effect of these other often unobserved quality variables. So this is why these very high price premium are estimated. They likely also capture these other unobserved quality characteristics. But the conclusion is the price premium across these studies is quite substantial, and they range typically between 10 and 15%. So that's kind of the estimate that is also in line with the estimates of our new study for Belgium. So there's really a lot of evidence of a substantial price premium across countries and across time periods. Now I turn to the second topic, so the improvement in energy efficiency over time. So why is this important? Well, this, and like Luca already said, this energy renovation is really crucial to obtain the climate objectives. And that's why the European Union and also Belgium, they have set ambitious targets for the houses to reduce the energy efficiency, or to improve the energy efficiency and to reduce the CO2 emissions of the houses. But besides achieving climate objectives, this energy renovation is also important for several other dimensions. So the reduction in energy consumption means lower energy bills. And this, especially now, which is huge energy prices, it's very important to reduce the energy poverty of a lot of households. Second is the security of supply. So if we consume less energy, yes, we will also become less dependent on countries outside the Euro area or the European Union for our energy supply. The energy renovation will also have a positive impact on health and well-being. And finally, it could also have a positive impact on employment and on economic activity. So what is now the objective in Belgium and in the Union is to go to a label A dwelling on average by 2050. So this means an EPC score of 100 kilowatt hour per square meter. First question is, how far are we now from these objectives? And I can show you, this slide shows the EPC scores of the sold houses in Belgium. So you can see the different bars. These are the different years. So in 2012, you can see that there was a very little of green colors. So the energy efficient houses, almost none of it's only 20% that are sold in 2012. The good news is that these have increased. So in 2021, it's up to almost 40% that has a label between EPC 50 or EPC 150. However, if you compare it to the target, so the target is on average label A, we are very far off from these objectives. So the black line shows you the average EPC score. So now for houses, it lies around 400 kilowatt hours per square meter per year. So this is very far off from the 100. Now for apartments, the story is a bit better. Why is that the case? Yeah, apartments, because of their building structures, apartments are surrounded by other apartments, so they have less loss of heat compared to houses. So they have on average a lower EPC score. However, also for apartments, there is a lot of yellow and gray and light green. So all these apartments also need to be renovated in the future. So this is the key challenge. Now in Belgium, so we have some estimates about how much will this cost and how fast will we have to go to renovate all the dwellings to label A by 2050. Well, the investment cost is about 50,000 to 80,000 per dwelling. So this corresponds to 250 billion to 400 billion in total to cover this renovation towards label A by 2050. So this very huge amount of investment. So it's almost of the same magnitude as the entire GDP or the government debt of Belgium. So it's really a huge sum. So the latter is 500 billion. So it's really almost of the same magnitude. And second, how fast do we have to go? Well, every year until 2050, we have to renovate 3% of the dwellings to label A. So this is also a very fast renovation pace. Now, there are several impediments to be overcome. So the first is the labor shortages in the construction sector. In Belgium, we have nowadays already a lot of labor shortages in the construction sector, but we need to renovate, to do this renovation on top of the existing work. So this is really a key issue, is to address these labor shortages in the construction sector. The second is about financing. So there is a recent study that showed that half of the families cannot finance a deep renovation, a deep energy renovation. Why is that the case? Because they already have a lot of debt and they cannot handle to repay additional debt. Third factor is that the payback time can be long for energy renovation, and this depends also on the type of house and on the current energy efficiency of the house, and very importantly also on future energy prices and carbon prices, of course. And finally, is there is also a split incentive between landlord and tenant, which can really reduce the incentives of the landlord to make the energy investment. So all in all, this is a very big challenge. So to renovate to label A, and this really a lot of different actors, including households and governments, and especially also the financial sector, can play a major role in making this happen. The final topic is on the house price indices. So we, in our paper, we constructed a new quality adjusted house price index. And in this way, we can take into account changes and improvements in quality over time. So if you would compute the simple average of the house prices that are of the prices of the houses that are sold in a certain year, 10 years ago, you will take the average of a lot of energy inefficient houses, whereas now houses have become on average more energy efficient. So you compute the average of houses that are more energy efficient. So you compare a bit apples and oranges, and this is not what a house price index should be. So it should compute the price of an identical house over time. And so this is what we have done. So we have constructed this new quality adjusted house price index, and the key contribution is that we really can quantify the quality improvements of these sold houses. So here you can see the results. So the black line is the index of quality. So 0 is the quality in 2012, and then you can see the line is the increase in quality of the sold houses over time. So the line is upwards. So this means that in 2021, it's about 7% higher quality than in 2012. And what our paper does is we really can decompose this increase in quality of the sold houses to different characteristics. And we showed that the green bars there, the energy efficiency, they explain the vast amount of this increase in quality of the houses. So houses have become more energy efficient, and this has pushed up the average quality of the sold houses. In addition, we also see that the size of the house has become larger. So the blue curves here, so the sold houses, so the second-hand houses, they have become larger. So again, we do not include the new build houses. So these have become smaller, but in the sample of the transactions of sold houses, existing houses, these have on average become larger. So this increase in quality, so again, you can then compute a quality adjusted index. So what we do then is to subtract the increase in quality from the index of average prices. And you can see that this really explains or about 7% lower increase compared to the average price index. So here we are. So the conclusion. So the price premium of energy efficient houses is large, and we also show that it has increased over the past decade. The energy performance of dwellings, they has also improved over time, but it should really improve a lot more to achieve the climate goals. And finally, we show that taking into account this improvement in energy efficiency over time in the hedonic or the quality adjusted house price index is really important to measure the price evolution of an identical house. You can find the link to our paper and also to the data below on the graph on the slide here. And I would like to thank you very much for your attention, and please feel free to ask questions. Thank you.
Thank you very much, Peter. And yes, please ask any questions from the audience, either just shout out or in the chat room. Whilst you're thinking about that, though, Peter, can I just brainstorm a little bit about those numbers? So if you talk about a 10% premium for an A versus a D, you had that range, but let's say 10%. The average house price in Belgium, I don't know, I'm guessing 300,000 euros. So about a 30,000 euro per house premium. How much of an energy saving is an A versus a D? And is this just the market rationally pricing the PV of future energy savings? Is it the right magnitude? What's an average utility bill? I don't know.
Yes, that's a very good question. So how does the price premium compare to the investment cost? Indeed, if you take a house of an average price of 300,000 euros, it's about 30,000 price premium compared to label D. So the question is, how much does it cost to renovate a label D dwelling to a label B dwelling? And as I showed you, this is about the current estimates, which are already made before the recent price increase. They amounted to about 55,000 euros for an average renovation to label A. So this is then label A. So it's almost in the same range. So it's a bit lower, but it's kind of the same magnitude. So but still lower than the investment cost. So I would say that it's not yet fully priced in, and especially now. So the renovation costs have increased strongly. So in the past year. So that's why I also believe that the price premium will likely further increase to really compensate with this investment cost increase. And that's the first dimension. So you can compare the energy price premium to the investment cost. You can also compare to future energy savings. And there we also did some calculations. And we showed, it really depends a lot on the prices of carbon and on energy in the future, how long the payback time will be. So with current prices, it's much shorter than with prices of 2 years ago. So it really depends on what your assumptions are for the future of these energy and carbon prices.
And I suppose there's several potential drivers. One is, yes, energy prices are going to go up, so that should increase it. Another is it's going to be more difficult to have a poor EPC rating. Energy Performance of Buildings Directive, all of these kind of regulations are going to start, particularly for professional landlords who have to rent out and have to reach a certain standard. Presumably there's that mechanism there. People are starting to think, I will get less rent, or I won't be able to rent out unless I have this upgrade. Is that something you can factor in, you can model for?
Yes, and that's why I believe that the price premium will really converge to the investment cost, because if this becomes compulsory to make this renovation, then the differential between a good energy efficient dwelling and energy inefficient dwelling, they will just reflect this investment cost, because people that buy a house in the future, they will have to renovate to this label A dwelling in the future. So that's why it's in Belgium. It's not yet the case that you are obliged to renovate to label A. So in next year you will be obliged in Flanders to renovate to label D. But in the future, we expect that this regulation will get more strict, and that will be reflected, I believe, in these price premiums. I believe that the gap between good and bad EPC dwellings, that it will increase.
Yeah, and I guess what I'm thinking is, you mentioned a 50 to 80,000 cost at the moment of doing this. If we talk about a 30,000, there's still quite a big gap, but over time it is going to converge with that price, and that starts to become the stage where it needs less of a subsidy, I guess. Yeah.
Can I raise a question? I mean, I'm very intrigued by your last chart on the Brussels. If you look to the black line, I mean, it's very intriguing for me that from starting 2020 is going up, because that was actually our discussion during the barbecue during the weekend. In my neighborhood, we noticed that the houses which are G are actually hunted by real estate, because the premium in renovating the house, which is G, is massive. And people are actually looking for these old houses that they can present the maximum impact. They renovate them and then they increase the renting. So I don't know. I mean, this is a very intriguing thing, because I see this happening in my neighborhood, where actually they smell the advantage of a renovation house. So I see the renovation wave taking action, because people are really trying to transform old houses which are G in something much better. So I mean, I don't know if I mean, I was intrigued by this 2020, the number going up. I don't know if you see it in the last
in the price premium. Yes, I really want also to stress that for Brussels, there not a lot of houses in Brussels, they're mostly apartments. So we have a small sample in Brussels, so the estimation error is quite sizable. So I would not really focus on an increase in the black line here, because it can be due to estimation error.
Okay.
So for Brussels, we have a small sample for houses. Walloon and Flemish region that are a large sample. So these estimates are more reliable than for Brussels. So that's an important remark. Could be due to estimation error as well.
Thank you, Peter.
We've had 3 questions in the chat room. As we don't have a huge amount of time, let me actually just, if I can, pick one of them, which is something I think is an incredibly good question. Is there any evidence of a difference in this effect in the dwelling sold to owner-occupiers and the dwelling sold to landlords?
Yeah, that's a good question. So we did not differentiate between the two. So possibly it could be that this price premium differs. There also they place the different incentives. So the benefits of a more energy efficient house, they come to the renter, so they pay lower energy bill. Depends also on the impact of energy efficiency on rents then. So I think there are different mechanisms. So for owner occupier, probably the energy savings will play a role. For landlords, there is the rent premium of energy efficiency. That's probably also the main driver of their willingness to pay for energy efficient house. But we were not able to differentiate because we do not have data on if the houses will be sold or rent. So I cannot give an estimate for that. I'm afraid.
It's a pity, because it is one of those things it's one of those barriers, isn't it? That you have a lack of alignment of interest sometimes between tenant and landlord on whether to make that upgrade or not. Well, there are always more areas to explore. I would like to ask more questions, but I'm afraid we do have to move on. Would you try to keep strictly to the half hour? Peter, thank you so much for this and for the presentation. And this presentation will be available on the Bauhaus website, and there are links to the underlying data if you want to take that further. But with that, thank you, Peter. And can I now move on to our second presenter today, Markus Seifert. Markus works for Define, the sustainable technology consulting firm. Most relevant, though, you will have seen that the EFIG group published in, I think it was April, is that right, Markus? Published the meta-analysis, the overarching analysis of these various studies that we spoke about earlier, looking at the correlation between credit and energy efficiency, available on the European Commission website. Markus, can I ask you to talk us through your study and what you found?
So absolutely, and thanks a lot for inviting me here to this presentation. Thanks a lot, Richard, and also to Luca. And also Luca, of course, for sharing so much of your thoughts also in the working group, which led to these results. So thanks a lot for that. And I hope you can see my screen and can hear me clearly.
Yep, we can.
Okay, perfect. So I would like to present you today the study recently performed by the EFIG. So the EFIG is the Energy Efficiency Financial Institutions Group, founded some years ago together with the UNEP-FI and the European Commission. And so we had a working group running for now basically 2 years, looking into very much of the details of the quantitative impact of energy efficiency on the values. So similar to what Peter has presented before, but of course also on the risk side, and in particular on residential mortgages here. And I would like to outline the results here a bit more in detail and show you what we have found. And I'm very much looking forward to your questions also then after the talk. So first of all, a bit of a background on the EFIG. So, in particular, the working group we have run for 2 years. So this was the working group on risk assessment. It was a 2 years effort together with many participants. I think in peak times, we had something like 70 people participating in our calls. And we had local hubs. So in the different countries, we had a methodology hub to discuss methodological aspects. So this was really a large scale effort here. And we're very happy that in 2020, we could then have our first interim report with the European Commission. And then, of course, until the end of 2021, get the report finalized with all the details and all the contributions from the various contributors here. And of course, I would like to also mention here the working group lead, which was actually Peter Sweetman. So I was just the co-lead, Carsten Glanting and Darren McCoy. So we spent a lot of time talking to our members, the member banks, but also other institutions to get the input here, to collect data. And I guess you have some idea how immensely difficult it is to actually collect data on these things. So as Luca said before, EDAP has been an icebreaker in that area. But of course, it's still not very easy to actually get real life data. So we were very happy that we could have 3 banks contributing their data to our analysis, and actually also they performed a lot of the analysis there. So it's really, we are building here on the results of the banks. And I think this is also very important when we talk later on about what's actually the impact here, that we have to see this from a practical point of view. So what does it actually mean for the mortgage business, the mortgage financing business as well, to really give a bit of an interpretation beyond the pure statistical results. So what have we been concerned about? So we had 4 key questions here. And the first one was, to what extent is asset energy performance correlated with credit risk and loan in arrears? So you see already here, this is the most important question from our point of view, but we could also really add some genuine analysis to the body of knowledge which was there before. The second one was, of course, how does this vary by various factors? So, for example, one can think about, is it just the owner's income which basically drives those effects? Or is it the wealth topic? Is it maybe the house prices being different for houses with different energy efficiency classes? So that you can think about many influencing factors here. And of course, it's very important to discern these factors to find out what is actually driven by energy efficiency and what is maybe then added by other effects. The third question was, how does this vary within the EU member states? I think that's also a very important question. Because I think before that study, it was not so clear how this really translates to some other jurisdictions within Europe. So, Luca, correct me, I think EDAP was mainly Italy and Netherlands, as far as I know. And we are very happy that we could add here 3 more jurisdictions, although one of them is not in a strict sense part of the EU anymore. So we have been looking at Finland, the UK and Germany. So 3 more data points where we can see similar trends across those countries. And the fourth question was about the causal link. So is actually the risk differential, or maybe also the value difference we see, is this actually being driven by energy efficiency, or are there some other factors behind that? That's a pretty tricky question, and I think we have not really finally answered that one, but hopefully we were able to contribute to ruling out some of the factors which are obviously not behind that effect. So you see that's a pretty comprehensive program of study here, and I think it would not have been possible to conduct these kind of analysis without the support of our member banks and of course all the very motivated members doing basically this in their spare time. So thanks a lot to everybody contributing here. We will have a list later on showing everybody who was involved in the 3 case studies. But to spend not too much time on this introduction, let's go into the results here. And I would like to start with the values. Of course, I have to admit that this study was less comprehensive than what Peter has been presenting before. So I'm very happy to see that we have now a new study also, which we could include in that one here. Because what we did is we basically did a meta-analysis of existing studies. So there was no genuine research involved here because we thought that this topic is already researched to quite some extent. So there are many studies out there. And I think the issue is a bit to find a way to see what is driving the different studies, because the study designs are vastly different. As also Peter pointed out before, depends a bit on the time you look at, the developments, what is actually impacting the current data, what can be the impacts in the future. So that's not so easy to discern. But what we saw here is really also a positive differential in the values of buildings, depending on the energy efficiency of the building. And what you see in the lower right corner here, that's a very simple graph just showing what we have found in the studies. And it compares EPC ABC over EPC E and F. So very simple one. Again, you see the broad range of estimates you can get here. But I think the main takeaway from our point of view was really all of the studies point out to a positive differential here. So there seems to be a green premium here for those houses. And it's on the median, it's something like 5%, which is probably a bit on the lower end of what Peter has presented before. But I think it's a safe choice here to say that there is a premium and that this premium is positive to a significant extent. So I think this is a very, very obvious conclusion out of these studies, and of course also of the many studies going into this meta-analysis. So we had something like 20 studies here being analyzed. But maybe to give one comment on how does this actually help in practice, because I mean, also when we look at it from a banking perspective, I think it's very important to note that not only that the face value is the critical one, but really what the risk involved here. And based on those studies, we can think really what is the risk, for example, for less energy efficient homes in the future now, but also in the future. What are probably some discounts you have to take into account? And that of course is very important in the banking business when you do the calculations, when you also think about pricing. So it's always good to look at the risk adjusted value. And maybe also to further note here, what we see at the moment might not be exactly the development we see in the future, because I mean, things have changed. I mean, in February in particular, but also now in the long run, we see that the transition will be much faster than probably anticipated by most participants in the market. So it's really crucial to think about future projections. So how can we get a handle on what's coming next? So what will be the impact here? Because again, this is really the very important ingredient for getting the pricing right. And I think if we want to finance the renovation wave, we have to also get the pricing right so that we do not incur a banking crisis just by doing the renovation. So I think this should not happen. And I guess we will later on have some further thoughts on these topics here. So that's a bit the value part, and let me spend a bit more time on the key result, at least in my personal opinion here, and that's the risk part. So the risk part, meaning for those of you who are not completely familiar with the, let's say, the terminology in credit risk. So we have been thinking about the probability of default. So meaning how likely it is that a borrower will default on his loan. I mean, we all know it's pretty rare on the mortgage side of the business. So people stop paying basically everything until they default on the mortgage, at least in most jurisdictions. So the numbers are low, but this is something we have to look at to really make this assessment, because credit risk is really the major risk of the European banks. So this is why they also pay a lot of attention to this topic. And within credit risk, we also have like two factors. I mean, this is the probability of default I just mentioned, but there's also the loss given default. So meaning how much you actually lose when you have to sell off a collateral after a default. Again, this involves the pricing topic. And interestingly, I thought when we started this analysis that we will see an impact certainly in the LGD, so the loss given default, but less so in the probability of default. Funnily, it was the opposite way. So it turned out that performing studies on LGD is much more difficult. It was much harder to get data. So we then at some point really focused on the PD part. And in the PD part, we actually found a correlation. So very much in line what the EDAP has been publishing before. We also confirmed this on on some case studies, which I would like to outline here, give you a bit of a flavor what this actually means. So we have 3 case studies contributed by member banks here from 3 different jurisdictions. So we have Germany, Finland, and the UK. And the member banks here collected data from the internal portfolios. They tried to match that to the energy efficiency information, which I have to admit was really the major time-consuming part here, because not all of the countries are as lucky as, for example, the UK, where you can simply download the database. So it was not so easy for most of the countries, and in particular for Germany and for Finland. We had to resort to modeling the energy efficiency of the houses. So because the data sources are either sparse or the data quality is not sufficient, so we had to really go for modeling part here, which again turns out to be not too difficult, interestingly, in some of the countries, because you can basically model the way the energy savings directives and so on also in the previous decades have been implemented, and this allows you to pretty precisely model the energy efficiency of the house. You can take that information, apply it to the bank's portfolio, to the buildings given as a collateral, and you can start analyzing that data. And I can really only recommend to all banks doing that who have not done that, because that's really a very informative exercise in terms of getting data, but also analyzing the data. When you start to analyze the data, I think it's very important to think about what could go wrong, in the sense, can you control for effects you do not want to specifically analyze here? Because we all know credit risk is driven by some very obvious factors like household income, loan-term valuations, loan-to-value, year of construction, but also macroeconomic factors like recessions, unemployment rates. There's also a bunch of credit ratings out there, so you can take credit scores, you can take the IRB scores, so if you have an internal model as a bank. Sometimes it's also simple things like the borrower age, which really drives the credit risk. So when you conduct these studies, I think it's very important to actually remove that effect from what you see in the data. So that's really the crucial thing, because otherwise you're completely swamped by things you already know. And we really want to extract the effect of energy efficiency here more specifically. And to give you a bit of an insight into the 3 case studies, maybe let's start with the case study performed by Allianz. So this is the mortgage lending part of the Allianz Insurance. We looked into their portfolios. Actually, we took a sample where we thought this is a very representative and high quality sample out of their mortgage portfolio. We did the proxy model. So basically, based on properties of the buildings, we modeled the EPCs, so the energy performance classes, and then started to see, okay, how does this compare with, in that case, not with the probability of default in the strict sense, but more like how likely it is that the borrower is in arrears. So that's the stage before people actually default, so they get in arrears, and sometimes they never get out of that phase again. So we looked at the probability of being in arrears. And what you can see here, that's probably too small here on the slide, but let me just explain here. When you go from left to right, you see, and you go from high energy efficiency to low energy efficiency, and you see from when you look at the y-axis here that the credit risk or the probability of being at risk increases here again. So this is when you left to right, good to bad, and then you see also the risk increasing here. You see some more. It's not only like 3 groups we looked here, so we grouped the energy efficiency classes together, but we also formed subgroups. So, for example, given a certain credit score, do we see already in that group with a given credit score, do we see differences there in those groups? So these are the smaller differences you see there. But again, it doesn't matter how you slice it. You always see a difference that risk gets higher with a less energy efficient home. And this was pretty robust. So we tried different ways of segmenting that and showing that, and did a lot of statistical tests on that one. So this was pretty robust. We always got this kind of correlation here from left to right, risk going up. The next one was by OP Financial. So thanks a lot for William, who is, I think, also in the audience today. So he actually did the major workload here on that case study. Again, it was a sample of 100K mortgages in Finland. William did the proxy model again because data was not available for EPCs in Finland in that width and quality. So again, a proxy model. And similar picture here when you go from left to right, so from high energy efficient homes to less energy efficient homes, you see an increase in the risk, and this is also the probability of being in arrears. So basically the same kind of picture. You see maybe these small orange steps here. So again, risk increases with a less energy efficient home. And last but not least, we had the study from Nationwide. That is the second largest lender in the UK. And this was also the most comprehensive study here because they had really a large sample size here. So that's nearly 700,000 mortgages from their portfolio. And as mentioned before, UK has the big advantage that you can actually access the official EPC register and get the data, match it to your portfolio, and do this kind of analysis. So this really gives you a much better data source compared to what we have to do in the other jurisdictions. So what did they do? They took the actual EPC data, matched to the portfolio, and they were just in the process of actually developing a new IRB scorecard. So when you do, as a bank, like internal models for your capital requirements, you do the so-called IRB models, which means you do this kind of statistical analysis I've outlined before on a more, let's say, a more strictly guided method, and you can assess that. And what Nationwide here did, and I think it's actually the first in kind on a global scale, that they really tried to include this in an official IRB scorecard, or at least they tested that. So I think it didn't went into production because they were just applying for one. But they really tested it with the same standards which have been applied to their IRB models. And what you can see here, this is actually what you see in the graph. When you have it in the IRB model, it gives you an estimate of your capital requirements, which actually depends on energy efficiency. And this is the graph here. So what did they see? Again, when you go from left to right, from high energy efficiency houses to less energy efficient houses on the right hand side, you see an increase in risk expressed here as a contribution to the capital. And what you see here obviously is it basically shifts to left and right. So you get a capital relief. You need less capital for energy efficient mortgages, and you need more capital for the less energy efficient homes here. And this is really something, for example, if you would do this in a apply for a model with that kind of properties to the supervisors, and let's assume they grant it, then basically you can also apply this in pricing. So this could directly enter into mortgage pricing. And this is really something which gives a very good use case on how to include these factors, or in particular energy efficiency, into the usual risk management frameworks within a bank. I think this is really a landmark case study here, and thanks a lot to Scholt and Caesar, who had done here the analysis. So to briefly summarize what we have seen here, there's a clear statistical relationship between energy performance of the collateral and the credit risk of the loan. So I think this is pretty clear, again confirming what the EUDAP has also shown before. We think that financial institutions should definitely tag their loan collateral in terms of the energy performance. So really to solve the data problem, to get energy efficiency as a key indicator into their databases. And of course, they should really try to analyze this, how this can help them in terms of managing their portfolios, but of course also try to include that into your IRB models. This could really help you a lot in terms of implementing energy efficiency into the usual processes when you do the loan business. So this was really very interesting, and I can only recommend to look into chapter 3 of our report. So it's on the European Commission website. Please look there. It's a bit technical, I have to admit, but if there are any questions, feel free to come up to either me or one of my collaborators here. So to summarize, let's come to the last slide here. We've been publishing that report. I think there was a preliminary version in January, which has been also picked up by the EBA then, with the EBA being actually part of our working group as well. It was published then officially on the European Commission website on April 8th. And when you read now also EBA's discussion paper on the role of environmental risks in the prudential frameworks, you see a nice box which actually goes back to our report. And they also have picked this up in their pretty extensive effort to categorize all the known facts in that area. So I think it's a very worthwhile read to look into the EBA discussion paper and see what is already picked up there. And of course, the interesting question is, and hopefully the next speakers can pick up on that one, is what will happen next and how this will contribute to actually, first of all, get the renovation wave done, get this really into the business as usual of all the financial institutions, and also make this a commonplace in risk management within banks. So again, thanks a lot to all collaborators here, and thanks a lot for your attention here, and I'm happy to answer questions.
Thank you very much, Markus, and very nice link into our next presentation. Before we go there, though, a couple of comments and observations. I don't want to say criticisms because I realise the constraints that you're operating under, but two observations about it. One is the countries that you looked at, the three big countries and the other two, are all quite rich. There's no poorer countries in there, and if this correlation is driven by an income effect, potentially it could be more relevant in Romania, Bulgaria, Turkey, the poorer countries where energy bills are a larger part of overall household expenditure. Just one observation. Second one is, you mentioned about not having enough data on loss given defaults and primarily talking about probability of defaults, which makes me think, well, a lot of these studies have been done in the last 2, 3, 4 years where actually the mortgage market's quite benign. You know, generally speaking, interest rates are low, house prices are going up, absolute levels of failures, credit failures have been very, very low. To what extent, is there any way of knowing, is there any way of predicting to what extent this correlation would survive a downturn in a very different environment? I don't know if you have any thoughts on that.
Mm-hmm. So maybe to comment on the whether it depends on being a wealthy country or not. I mean, what we have been looking at is basically only differences within certain countries. So I mean, OP Financial has been looking at Finland. So just comparing good and bad in Finland. Allianz has been looking at Germany, nationwide at UK. So what we, I think, can fairly conclude is that within those countries, there is a differentiation. Of course, it would be interesting, for example, to do a cross-country comparison. So, for example, look at Eastern European countries, Southern European, Northern, and see what the drivers are. But I would actually assume that when you also even look in those countries where it's not so easy to actually get the data and to do this kind of studies, but I think you would probably see a similar effect because to my let's say, in my opinion, I think the energy efficiency is something like I mean, before you said always it's location. And I think now it's more like location, energy efficiency. So you will see similar effects actually also in other countries. So when you then finally would be able to do a European comparison, I think you find similar effects. Of course, you have to correct for the overall income in those countries. Yes, that's, I mean, what you probably have to do. But I think at least what we have seen so far, it should be pretty stable. But of course, this is maybe just my opinion here. And in terms of LGD, so you said that it's a benign environment. Yes, it has been. So that's absolutely true. But again, if we think about this location, energy efficiency, I would assume that a lot of these, let's say, these for the very energy efficient houses, a lot of this effect will survive because these are the houses then which will retain their value and will also have a good outlook in terms of value. So there will be always in demand. But again, this is a bit my opinion here.
We've had several questions. Let me see how many you can get through in a couple of minutes. First one is, how much of this correlation is linked to the fact that it's basically wealthier households are buying more energy efficient buildings or more likely to upgrade or whatever. Can we control for that?
Yes, and this is actually what we did. So we tested a lot of strategies to include control variables. Also, when we did the statistics, I mean, in the slides I just listed here what we tried to control for, but we had really an in-depth methodology here to control for those variables. So I do hope that we have removed most of these effects in our analysis. And even if we remove that, we still see a significant correlation in statistical terms. Of course, one has to see whether this, let's say, how stable that is. But what we have seen so far is in the studies we've conducted, it's pretty stable. So you can do whatever you want. I mean, you always see this effect to some extent.
Mm-hmm. I know you can't prove the cause of the correlation, the causation correlation thing. Knee-jerk reaction. Don't have to back it up statistically. What do you think is the main driver of the correlation?
So I would, let's say, argue the other way around. So I think we can think about what is not driving this here. So proving causation is very difficult, but of course I think we can exclude some things. So it's obviously not the income thing. It's also not the absolute value of the house. So this is obviously what we can already exclude here. Whether this is, for example, driven by the energy prices. So we had, for example, a lot of discussions about, in particular, when the energy prices were low, like they were a long time. Does this actually give enough difference to see that kind of effect? So because let's say if it's 100 euros a month more or less, if you have bought a very expensive home, maybe it doesn't make such a difference. But of course, these factors will change in the future, and I would expect that this will be even more pronounced in a sense, also more easy to analyze when we now look in these, let's say, new times with higher energy prices, also with a much stronger demand for energy efficient homes. I think this will be more easy to discern when we have, let's say, a study in 1 or 2 years.
Yeah. Thank you very much, Markus, and thank you for the overall work that you've done here. The report, it's an incredibly useful report. It's all available on the website. There's a link to it, and it also, as I say, segues fantastically into our next presentation.
Yeah. Richard, can I? Sorry
Okay,
for
yes,
interrupting. Just to invite Markus to a next step. Causality is the big issue. I think that the increase of energy prices, you say, that a fantastic opportunity to us to make a new study, maybe in a few months' time, and take a picture of the market. Now we have a basic line, EDAP and your study have been a basic line. If we do the same study, maybe in a few months' time, when data will be available, we can also give some clarity about the causality, because we will have a nice test into the market. So this is just an official invitation to Markus to work together again to answer also the question of causality. Sorry, Richard.
Happy to do so, Luca. Thanks a lot for that offer.
Sorry, Richard.
No, there's a lot more work still to be done, but this is a great progress. Well, you've already seen a picture of the cover, a picture of the reference to the EBA report, and those of you who were with us last month will remember that that Myra Lamraven of the EBA gave an overview of the EBA's work in this area, and there were an enormous number of sectors of it. So what we'd like to do is focus on the most topical one, which is the modelling of ESG risks within prudential frameworks. The most topical because this has only recently come out as a paper. And this is going to be presented by Katrin Weissenberg and Dorota Siwek from the risks unit and ESG risks unit in the EBA. I think, Katrin, you're going to be doing the talking. Katrin, can I hand over to you, please?
Very much, Richard. So good afternoon, everyone. So yes, indeed, my name is Katrin from the EBA. I think originally it was my boss, Dorota, that was meant to present, but I will step in for her as well as I can. In any case, she's online, so later on for the Q&A, so I think we can both kind of take them. So indeed, so we're going to be talking about the role of environmental risks in the prudential framework, and in particular about the discussion paper that we have very recently on the 2nd of May published. So just before I start, I will give a bit of a background of the EBA. I will stay very brief because I think Mira has already spoken to you about this as well. I will give a bit of background about where the prudential framework, where Pillar 1 in particular sits in terms of the overall ESG work that we are conducting here at the EBA, and we'll then focus more on the discussion paper and in particular focus on credit risk and mortgages. I guess this is probably the most relevant for everyone here. So then, who are we? So we are an independent EU agency that was established on the 1st of Jan 2011, and we took over basically all the tasks and responsibilities from SEBS. Our mission is to build a single regulatory and supervisory framework for the entire EU 27 banking sector, and in particular to ensure an efficient, transparent and stable single market, which will ultimately benefit consumers, businesses and the broader EU economy as a whole. So how do we do this? We first of all, we develop a European single rule book. So this would be all the various technical standards, guidelines that we publish. We also promote supervisory convergence and cross-border supervisory cooperation, mainly or also through supervisory colleges and the work that we conduct as part of those. We also publish quite regular reports on assessing the risk and vulnerabilities across the EU banking system, and also look at various topics such as consumer protection, anti-money laundering, breach of union law, cross-border mediation. I think important here to note is, although we promote supervisory convergence, we are not a supervisor as such. So this is then done by the national competent authorities plus the SSM. Also important here to note is that ESG in particular is a very horizontal topic within the EBA. So it feeds into various products and is basically worked on across the entire span of units and departments within the EBA. On the next slide, again, I will not go into detail here. So the key message here, I think, is that Pillar 1, or the prudential treatment, is basically just one element of the ESG work that we conduct. So we look at very different mandates, different aspects, and importantly, we cover all three pillars of the regulatory framework. So we cover Pillar 1, which is about the own fund requirements. We cover Pillar 2, which is about institutions' risk management and SREP, so the supervisory review process. And we also look at ESG in the context of Pillar 3, which would be all about disclosures to market participants, basically. Then moving on to the actual discussion paper. So here you can see that this is quite a long-term process, so to speak. So the discussion paper that we have published on the 2nd of May, that was also mentioned in the previous presentation. This is very much just the first step towards the final report that is due in June 2023 to the Commission. And if you have read the discussion paper, you will see that at this stage, we don't really provide answers as much, but it's more about exploring and also of posing questions to the stakeholders. So in total, we have included 35 questions, and we will, in the meantime, whilst the public consultation is ongoing until the 2nd of August, and also until our final deadline next year, we will continue our analysis, and in particular, we will also expand our analysis to include the social aspect, because at the moment, the discussion paper so far only focuses on environmental risk. Maybe an important thing to note is that the publication of the report by 2023 will not necessarily imply that there will be basically a change to the prudential framework. Rather, it's a report to the Commission where we are basically considering whether, when and what changes to the prudential framework are necessary, and the Commission will then decide where it takes this report, how it responds to this report, and in any case, there will then have to be the normal legislative processes to be undergone. So it's a very long process, just to note, so we're just at the beginning of everything. Also to note here is that, of course, we need to take into account whatever is going on at the Basel level. So our current prudential framework is built on the global Basel framework. So the BCBS is also looking into this topic. So they're also looking at the integration of environmental risk, or at how environmental risks are reflected in the Pillar 1 framework, in the prudential framework. So we have to very closely monitor what's going on at Basel level. They are currently focusing on climate risk, but we're also very much involved in this work. But just as a note, that everything we do at EU level, of course, needs to be closely coordinated with what's happening at Basel level. So in the next slide, it's just a brief overview to basically show you the complexity of the prudential requirements that we have in the EU. So you see two stacks. On the left-hand side, you have the total SREP capital requirement, or the capital stack, and on the right-hand side, it's about the leverage ratio. So both stacks are basically consisting of Pillar 1, then you have additional Pillar 2 requirements, then you have a couple of macroprudential buffers, and then the Pillar 2 guidance, which is basically based on the stress test results, which is not binding, the Pillar 2 guidance if applied, but nevertheless it still is part of the capital stacks. Now the key difference is that at the left-hand side is basically taken into account, or basically is based on risk-weighted assets. So this is to show you that this bottom left-hand part, so Pillar 1 minimum requirements, is what we are focusing on in the discussion paper. So this is what it's about, just to show you where it's sitting within the overall requirements. Now, what are the principles that we have adopted for our analysis of Pillar 1 requirements in the context of ESG or environmental risks? So first of all, we feel it's very important to take a holistic approach. So that is to say that we also need to take into account other tools. We need to ensure that there's no double counting, in particular under the Pillar 1 framework. So it's basically all the calculations are basically based on certain accounting frameworks. So we need to make sure that basically there's no double counting. So if E is already reflected in accounting standards, then there might not be the need to reflect it elsewhere. The same applies to Pillar 2 requirements, to Pillar 2 guidance, which comes in response to stress testing, as I've mentioned before, and also macroprudential buffers. Then second key principle is that we are taking a risk-based approach. So the key objective should be to keep or maintain the resilience of the financial sector. So there should be no substitutions of specific policy tools in the prudential framework. So it should really, any alteration should really be based on risk factors or a rationale. The rationale should always be risk. It shouldn't be just a simple policy tool. Also, what we are to note is that there's a very specific nature to environmental risks. So this means that it causes quite a few challenges also in our analysis, and I think these are quite well known. So these are about data availability and reliability. They are about the historical observations versus the forward-looking perspective of or aspects of environmental risks, and then of course also the time horizon of the prudential framework. So it's rather short term, whereas environmental risk are usually seen in a more long-term context. And then last but not least, another key principle is that environmental risks are considered as drivers that impact basically traditional risk categories. So we stick to our traditional risk categories of credit, market, and op risk, and we see environmental risk, be it physical or transition risk, driving those risk categories through various transmission channels, such as profitability of corporates or adjustments in house prices. In the next slide, we wanted to just give you a bit of an overview of the landscape in the EU banking sector. So you will see here that just under 85% of capital requirements are actually accounted for by credit risk. So this also explains the fact that if you already had the chance to look at the discussion paper, you will see that a huge chunk is actually about credit risk. So it's a very long section, but this is also due to the fact that it's so important, but also so complex. Then to the right-hand side, you will see that in the EU, basically, there's quite quite even use of standardized versus the IRB approaches across countries. So the EU27 average, you will see that it's 50-50 that are using the standardized approach versus the IRB approach. Of course, there's differences across countries, some countries using just the one or just the other. And this then brings me to a key slide where we are trying to summarize a little bit about, or we're trying to summarize a little bit how we analyzed environmental risk in the context of the credit risk framework. So first of all, we started this analysis basically with an overview to what extent environmental risks are or may be already reflected in the current framework. So I think here it's key to note that the current framework basically incorporates a couple of mechanisms that can be adopted if need be, so for new risk drivers, whilst keeping the current framework stable. So that is to say, the current framework does incorporate adaptive mechanisms that can be changed when new risks materialize. So the overall framework through that can basically stay stable in a dynamic environment. So what does this mean on the standardized approach side? So here we've identified a few adaptive mechanisms that would allow for the incorporation of new risk drivers. So firstly, there would be the external credit assessment. So we know that quite a few of them already include ESG aspects. So it's not mandatory, but a lot of them already do. And indeed, they are obliged to include any material risk that will materially affect credit risk. So yeah, whatever affects credit risk materially would be included. And I think there's the expectation for this trend to increase, basically. Then secondly, there's also due diligence. So this would be the due diligence on the side of institutions beyond using the external credit assessment. So it's essentially almost like a safeguard to using these external credit assessments. So this is essentially that's just to say that any material aspects affecting specific obligors should be considered by institutions on top. Then, very importantly, there is the valuation of collateral. So the valuation of collateral directly feeds into the calculation of capital requirements. So essentially, capital requirements will reflect E-risks or ESG risks to the extent that the valuation of collateral does so. So in the case of immovable properties, it's the same thing. So the price of the property directly feeds in as an input into capital requirements. So there's already been a few observations that property prices reflect already, for example, energy efficiency. We've seen that houses with better energy efficiency have see higher property prices. We also see that physical risk is reflected in house prices. There's been some studies on this. So essentially, E will be reflected in capital requirements to the extent that it is reflected in the valuation of the collateral. However, we would encourage there to be a bit more developments in the market of valuations. So just to make sure that basically it's integrated in a consistent and explicit way in the valuation of properties. So our conclusion then on the standardized approach of the report was that yes, there are ways or adaptive mechanisms for the integration of E in the capital requirements under the standardized approach, but potentially only to a certain extent. So the question then is probably rather to what degree is there, what's uncovered? So to what degree do we need to maybe have additional adaptation mechanisms? And here I think there were potential two further considerations can be summarized or have been put out there. So first of all, there would be further granularity of risk weights. So here this could apply to both collateralized as well as uncollateralized exposures. So one could think, for example, about reflecting energy efficiency of mortgage or considering energy efficiency of mortgages in the granularity of risk weights. But I think here it's important to say that for this consideration, it's really important to look for the strongest credit risk differentiating factor first, and it's not so clear whether the environmental aspects actually qualify for being the strongest risk differentiating factor. Then also there's forward-looking mechanism again. So if the current adaptive mechanisms cannot capture this appropriately, then perhaps other tools could be considered. And actually in this consultation paper, we would be very happy to hear feedback from stakeholders on these specific aspects. Now moving on to the IRB approach, also here, it has been recognized that internal models allow for the recognition of new risk drivers, but this is subject to certain conditions. And I think it has to be noted that the IRB approach by nature is the most flexible approach, just because it's basically based on institutions' models. So there might be a bit of difficulty to reflect the forward-looking aspects under the IRB approach, because there's certain restrictions involved in this IRB approach. So these explicitly, they refer to model performance and data representativeness. So these two basically imply that historical observations or data should be used. However, the IRB approach allows for possible conservatism in model applications. So what that means is it's the so-called model override. So basically, an institution can apply additional conservatism when assigning the ratings if in individual cases the obligor is exposed to increased risk, which is not reflected in the model. And apologize for reading my notes, but these are also quite technical for me. So hence I have to look at my notes here. Then also importantly, under the IRB approach, the value of collateral again. So as with the standardized approach, again, the value of the collateral, or that is the E, will be reflected in capital requirements to the extent that the E is reflected in the value of the collateral, because the value of the collateral is reflected in the LGD estimates, the loss given default estimates, and these are direct inputs into the capital requirement calculations. So yes, indeed, also under the IRB approach, so we acknowledge that there's that it allows for the recognition of new risk drivers, but the discussion paper also poses a broader question on whether the design of the approach could be reconsidered. So we know that under the IRB approach, basic capital requirements are calculated through a risk weight function. So that has the LGD, the PD, the probability of default feeding in, but there's also a systemic risk or systemic factor incorporated, and that comes through different correlation efficient for different types of exposures. So for example, for mortgages, it's quite high. And there could be potential further consideration as to whether there might be a justification to recalibrate those correlation coefficients. So this was, in a nutshell, what we have done on credit risk and our analysis and how far environmental risks are already reflected in it, and any further considerations that could be explored. Which will bring me to my last slide, where I would like to just recall again the questions that we have included in the discussion paper. So as I said, there's 35 questions, quite a few of them. We're very cognizant or very aware that not all of them might be as relevant to all of you or everyone or all the stakeholders. So even just answering a few will be absolutely fine. We would be very happy to hear feedback, to hear opinions by or until the 2nd of August. And just to note that questions are basically split into two types. So we have some very specific questions or more technical questions regarding, for example, existing mechanisms within the framework. But we also have more general or more fundamental questions which apply basically to the paper throughout. For example, regarding the overall level of capital in the banking sector, appropriate time horizons. So yeah, we would be extremely happy to hear, to get a lot of feedback. Also, any additional supporting evidence that we might use would be very happy to hear it. And with that, my presentation comes to an end. I think Dorota and myself will be very happy to answer any questions. Thank you very much for the opportunity to present. Thank you.
Thank you very much, Katrin. It's a very comprehensive, really a lot of interesting stuff there. I'd like to throw it open to everybody in the room for any questions, but I'm going to kick off with a couple of ones. One is, you're doing this at the same time as BAL is doing this. How does that work? Surely we have to implement BAL rules, but if we're developing them in parallel, they've got to be different. Is there a process of coordination? Are our thoughts on the same lines? Are they relying on all of the good data that we're producing in Europe? How does the integration process work?
Katrin, if you want, I can take that question. Thank you, and thank you to Katrin for taking over this presentation. That's because I have some issues with my voice today, so Katrin kindly agreed to take over the presenting. But I think I can answer that question. Indeed, there is a cooperation on the global level between various initiatives. So what we are doing here at the EU level, it obviously also feeds into the Basel discussion. So our considerations here, we also of course bring it to the Basel table. We participate in all the developments. We are part of the working groups, and we of course promote the ideas that we adopt here in Europe. So of course this is a iterative process, and there is certain negotiation also involved, especially at the later stages. But of course, this work that we are doing here at the EU feeds into the work of the Basel Committee. And as Katrin already mentioned before, this is a long-term project, and therefore there will be, of course, the opportunities to present various developments in various jurisdictions along the way.
Mm-hmm. And the other question I wanted to talk about, I'm not clever enough to understand the IRB, but I think I just about understand the standard approach. And I'm used to that in the context of credit. You know, this credit quality has this risk weighting, that credit quality has that risk weighting. But in the last presentation, and you know, I've seen it before, there's a nice chart from Nationwide of the correlation between EPCs and the amount of capital they think in their model any given EPC requires. How do you map? We can have it. Are we talking about a simplistic EPC A has this in the same way that we do with credit quality step 1 has this risk weighting, or is it a more complicated interrelation than that?
I don't know how the previous studies were done exactly, but EPC is of course not an input, not a direct input to the capital calculation, right? So this is not. But because the EPC and as studies have shown, as also the previous presenters have shown, the energy efficiency does influence the price of the property, the valuation of the property. And here, and the valuation of the property is the factor or direct input to the calculation of capital requirements. So in this way, this sort of indirect way, it of course affects also the level of capital requirements that come from this calculation. So yeah, exactly. These are the aspects that we are looking at. So these effects can come through two effects. This also was presented before in the previous presentation. So either it's the effect on the value of the property, so sort of like the LGD effect, which we have explicitly in the standardized approach through the value of the property. Or it can be the effect of the sort of PD effect of the credit worthiness of the client itself, which at the moment is not reflected explicitly in the standardized approach, because standardized approach, and it's not only about mortgages, right? This is about also the other exposure classes in under the standardized approach. The calibration is done on the overall level with one basically risk weight for all unsecured exposures in a given exposure class. that's a simplification, of course, right? But but just to present the idea, so the calibration of this one standard risk weight that is applied to all the obligors, regardless of their credit worthiness, is to ensure the overall adequate level of capital requirement. So this is the characteristic of the standardized approach, that it is a simplified approach, of course, by definition, right? Whereas under the IRB approach, we have this differentiation by credit worthiness through the PD element, right? So that's why here, when we are talking about this PD effect under the standardized approach, this is something that at the moment does not really exist in the standardized approach because of its simplified nature and because of its overall calibration. And therefore, if we wanted to change that paradigm of the prudential framework and this approach, we would first need to look for the driver of risk that is the strongest, right? Because it wouldn't make sense to start with something that is, let's say, less significant, that has less significant effect than perhaps the other drivers of credit risk that may exist. So this is one of the aspects that should be considered here in this context.
Another question that I've been sent from someone in the audience was about this point about double count between what the accountants say and what the capital says. And clearly, capital's there for the extra risk, over and above what's provisioned already by the accounts. How do you assess how changes in the accounting treatment influence the changes in the prudential treatment, the unexpected loss treatment? How do they interact?
Indeed, these two elements are interlinked very closely together. So the accounting framework is the basis for the calculation of capital requirements, and in principle, and again, it's a simplification, but to clarify, and especially under the standardized approach, the expected losses are in principle covered by accounting rules through the impairments, through write-offs, also through fair value rules for the financial instruments. So any expected losses or expected credit losses, as is the terminology under accounting framework, should already be covered there. And these are the effect of on the institution's capital is that they are directly deducted from the capital, right? Any impairment is directly deducted from the capital. So this is already fully covered. So what the capital requirements are only for the unexpected part of the losses, right? So that's why this has to really fit together. So whatever is considered an expected loss and covered by accounting should not be considered as unexpected loss and be covered again. So this is the relation between one and the other in very simplified terms.
Thank you for clarifying that and for your presentation. I'm guessing the European Mortgage Federation, ECBC, is going to be making a reply to all of these questions. So for anyone here who wants to contribute to the discussion, Luca or Jenny, please see who wants to.
Yeah, well, Jenny, we are preparing the response, but if there is anything that we can do to support your work in this exercise, we are more than happy to stay at full support of the European Banking Authority as a European Mortgage Federation, but also as Energy Efficiency Mortgage Initiative. We have started the collection of the feedback from our members, and we will revert just before holidays on the 2nd of August. I think that's, I don't know, Jenny, if you want to add something, what we are doing.
No, in the interest of time, I think we can carry on, but we will certainly be contributing as much as we can. Thank you for the very interesting presentation.
Thank you very much, and we're looking forward to your responses.
Thank you very much.
Thank you to you both. We're now going to move on to, sadly, our final presentation today. We're now going to move to Frankfurt and the European Central Bank. Carlo Di Maio and Marie-Therese McDonald are going to be talking through the ECB's comments on the banking package. Probably easiest if I ask you to explain that. Who wants to start, Carlo or Marie-Therese?
Good afternoon, and this is Carlo. So I will start with the short overview of the ECB opinion focusing on transition plans, and then I will hand over to Marie-Therese for some messages on commercial real estate and climate risk. Let me share my screen. So
Got it. Yep.
you should be able to see this in presentation mode, right?
I can, Carlo. Yep, got it.
Good. So I'll be going through some of the messages that you might have already read in the ECB opinion on the banking package, and I will focus particularly on transition planning. So this is one particular item of the broader ECB opinion that we thought was important to focus on today. Just one general message, also to understand a bit more the focus of the ECB on transition planning. That's the standard, let's say, view of the ECB on climate risk. Three main, breaking down in three main parts of the problem. The first one is that, of course, climate risk has a far-reaching impact that can be really stopped at borders. The time horizon is not the standard one. We know that the impacts extend over 20, 30, 100 years. But what we also know, the third important message is that what happens 50, 70, 100 years down the road, 20 years down the road depends on what we do today, the short-term action. And that's why the view of the ECB is that banks should have a forward-looking, comprehensive, strategic approach to this risk. That's because what banks are doing today will determine the impact on their balance sheet down the road. Just to be clear, what we're focusing here is the single materiality concept. So it's not what banks do for the environment, but what the risks mean for the balance sheet of banks. So even if we stay in the single materiality concept, banks, what banks do today will determine the impact they will suffer 3, 5, 10 years down the road. So a short overview, very condensed, of what the opinion says on ESG risks. So the banking package of the Commission, CRR3 and CRD6, introduce a number of rules, let's say, on the management and supervision of ESG risks. Specifically, there is an obligation for banks to assess and manage these risks, including plans to manage the transition. There are specific powers that are provided to competent authorities, including the ECB, to address these risks. And there is one particular interesting point, that is, it is acknowledged that the competent authorities have the possibility to act for risks arising in the short, medium, and long term. So the time component of this proposal of the Commission is a new one in the context of the banking regulation. And then there is also new definitions for ESG risk, as well as changes or extension of the requirements in terms of reporting and disclosures, and the Pillar 1 report that EBA just presented. What we expressed as ECB is that we have strong support for the general objective of the ESG considerations in the policy, in the banking package. We also acknowledge that climate and environmental risks should be prioritized over social and governance for a number of reasons, including also data and methodology. So we know that we have more data and more advanced methodology for climate and environmental right now. That's why we consider it's appropriate to prioritize climate and environmental risks. We support the requirement that the institution should have plans to manage the transition risk. We also support the related enhanced supervisory powers. What we do is we call for EU-wide science-based climate scenarios. Why this is important? Because we want that there is an established EU-wide benchmark that can be used to assess transition risk, that by definition is a risk with respect to something else. And that something else we call for European EU-wide science-based scenarios. We also call for the prioritization of some EBA work streams, and specifically, we consider that the mandates for DBA, and I have sympathy for my EBA colleagues, are very important, but also a lot of heavy work. So we consider something should be prioritized in order to focus resources. And also we call for the Commission to align with the definitions that EBA has proposed in the ESG report. We further welcome, in the opinion, the proposal to apply proportionally the disclosure requirements to all institutions. And also we welcome the fact that the Commission wants to anticipate the deadline for DBA to provide the report from 2025 to 2023. We think DBA is well positioned to achieve this result. Focusing on transition plans, so there are three key articles in the CRD6 proposal of the Commission. The first one is in Article 76, the requirement for the management body to develop plans and targets, so to monitor and address the risk arising in the short, medium, and long term from the misalignment. So remember this word, misalignment of the business model and strategy with the relevant union policy objectives. So it's an important concept because we are reframing transition planning not as a way to drive the institutions in a way that is compatible with the Paris Agreement, for instance, but we are framing in prudential terms as the risk that arises from the institution that is disconnected from the transition pathways. In terms of competent authorities, then in Article 87A and 104, the proposal of the Commission introduced a mandate to ensure that competent authorities should ensure that the institution manage these risks, also in longer time horizons, for instance, at least 10 years. The competent authorities are also mandated to assess and monitor the plans, these transition plans, so-called established under Article 76. And we are also empowered in the draft proposal of the Commission to require institutions to reduce the risks arising from this misalignment, which means in the current proposal is foreseen that if the institution deviates from pathways and this deviation is assessed as being a prudential risk, we will be empowered to react. The role of DBA is to issue guidelines, for instance, on these transition plans and these plans, and how those should be prepared by the banks, as well as including reference timelines, targets, and milestones. Just a step back. If you take the EBA report on ESG risks that was published last year, you will see that this idea of misalignment is not a new one, but was actually already contained in the EBA report. So just quoting two small parts of the report, you will see there that the report already acknowledged that the extent to which the institution's overall exposure diverge from the objective of the transition, this is an indicator of transition risk. Also, the report acknowledged that by steering the business in a way that is consistent with the transformation of the economy, ensures that the institutions are more resilient to ESG risks. So with that, the opinion of the ECB supports the inclusion of ESG risk and the plans to manage transition risk in the prudential regulation. This is important to bridge the gap between long-term commitments of the banks and short-term actions. So to say, we want to understand the risks that lies in the commitment to be net zero in 2050 and what is the actions that the banks are taking with respect to climate risk today. There is also increased transparency with respect to the competent authority on the risks that the institution is facing, as well as the possibility to have a proactive review of reputation and litigation risk. Why? We already see this coming in the news. Actually, there has been quite a stream of news in the past weeks, but basically this relates to banks having net zero commitment in 2050, but cherry picking transition pathways until 2030 to not adjust their business model. So the banks remain in control of what they do for their strategy, but surely investors and stakeholders could determine that this has an impact on their reputation. We consider, as we said, very important that DBA focus on delivering the mandate on transition plans 12 months after the final approval of the banking package to ensure that the institutions can timely deliver on their transition plans. And also we welcome the fact that the supervisory powers are now framed in a way that the time horizon for action is consistent with the time horizon of transition plans. Very important, we call for integrating scientific analysis into policymaking. This is by definition a risk that should be framed having in mind the scientific underlying evidence. And this is very important because by selecting different scenarios, banks can achieve different transition pathways, but not all scenarios are grounded in evidence and science. So this is a key point for us in terms of proceeding with this work. To conclude, some of what the other stakeholders around the world think, in a paper published by the PRA was calling banks to manage the risks with respect to the transition pathways. The supervisory policy manual of the Hong Kong Monetary Authority has included now transition risk framed as the risk of inaction of banks with respect to transition trends. The OCC has taken a different view. They have considered that the banks should review their public statements, for instance, net zero commitment, and understand how this relates to their strategies and if their strategies are aligned to their public statements, which is more the reputational litigation angle we just described. Then going a bit to some private initiatives, PACTA is one of the key actors in the market for what concerns climate scenarios. The TCFD has focused on the disclosure of plans, and in this case has looked more at the double materiality angle, which means not only managing the risks, but also contributing to the transition. And last, the GFANZ, the Glasgow Finance Alliance for Net Zero, that is a recent actor that is collecting voluntary pledges by banks to become net zero, and we know they will be publishing soon some more detailed information for their members on how to operationalize those commitments. So with that, I will stop here and maybe pass it already right away to Marie-Therese for the second presentation, and then we can go for comments. I can share the presentation from Marie-Therese.
Okay, perfect. Great. Thanks a lot. Good afternoon also from my side. So my name is Marie-Therese McDonald. I work in the Credit Risk Experts Division of the ECB, so in horizontal supervision. So this presentation just gives a brief overview of what of how we see the integration of climate risk into credit risk management practices for commercial real estate. So I guess the first question is, as supervisors, why do we care about the integration of climate risk into credit risk management, specifically for commercial real estate? And on the first slide, you'll see just some very high-level statistics. So firstly, in terms of the building sector overall, and the building sector is actually one of the highest carbon, or has one of the highest carbon footprints worldwide, accounting for about 30% of global greenhouse gas. Now, this obviously covers construction and the buildings actually themselves, but when it comes to banks, banks are actually one of the main funding sources for the sector. So along with insurance companies, pension funds and other institutional investors. And when we look at bank lending, commercial real estate actually accounts for about 8% of total loans and about 20% of total corporate loans. But the picture is quite different when you look across the different countries. If we go to the next slide, so where do we see the most immediate impact in terms of credit risk? I think we've discussed quite a lot of different aspects or different angles today, but this is just specifically on, I guess, the shorter to medium term impact. I think it's important to give you some context. So in terms of commercial real estate, it's probably good to take a bit of a step back and just give you a brief overview of what's going on in the market at the moment. So CRE is quite a diverse asset class. So it covers the main kind of asset classes would be offices, retail, hotels, and then residential accounts for quite a lot. And at least for office and retail, what we've seen in the last couple of years is there's quite a material structural change or structural transformation going on. And this has been amplified by COVID. So what do I mean by that? So for retail, we see a big shift away from, say, the traditional high street shopping experience onto to online. And then in terms of office space, there's a huge shift towards home office. And this then translates really into, particularly for office, is that the office space that's actually the amount of office space required is reducing, and what is actually required, what kind of office space is required, is also changing. But this really translates to a drop in demand. And where we can see this is really that there is kind of a bifurcation in the market. So demand is really shifting towards better quality locations, but also very much better quality assets. And investors, particularly international investors like US funds, are really demanding high quality, we'll say, buildings and an office space. In terms of office space, they really want these slick IT infrastructure with great kind of communal spaces, because that's where the demand is. And the demand really centers around, one of the elements is really around energy efficiency. What this also means is that in terms of negotiating rental contracts, the demand really lies, or the power really lies, with tenants. So the ability to negotiate or to increase rental income is really, really limited. And this becomes very, very relevant for credit risk, which I'll explain in a second. So in terms of integrating climate risk into credit risk management, for existing buildings, older or poorer quality assets will now need to be improved in order to reduce carbon emissions for obvious reasons, or to comply with regulations. But the current market dynamics, which I've just mentioned, also means that landlords of office and retail in particular will need to improve their buildings in order to maintain or retain tenants. But the costs, I think we're all very, very well aware of the situation, the broader situation at the moment. So the costs in terms of improving energy efficiency or improving the quality of assets has increased quite a lot. And in some cases, from a building perspective, what we've heard from banks that we've engaged with is that it actually probably makes more sense in a lot of cases, not a lot, but in some cases, to tear down the building entirely and reconstruct it. But construction costs overall have also increased. So these higher construction costs also will impact the new supply. And it could actually make a lot of, we'll say, pipeline projects non-viable. So it could reduce the overall supply. So when we look specifically then at credit risk, there are two main impacts from all of this that I've just mentioned. So the first relates to the actual cash flow that would be generated in order to repay existing loans. And as the cost of capex, or we'll say retrofitting properties, increases, borrowers may not actually be able to afford to repay their debt. And this is especially important given the current dynamics that I've just mentioned in terms of tenants and the power with tenants, or the power being held by tenants. Because it's, for older quality buildings, it's probably less likely that landlords can pass on these costs to tenants. And this will really put pressure on the affordability, or say the cash flow generation capacity of these buildings, and may lead to elevated defaults. Also, this is a very simplistic way of looking at this, but just bear with me. So in terms of collateral valuations, an increase in capex, all else being equal, would lead to, we'll say, a decrease in valuations, and therefore an potential increase in losses. But I should say there's quite a lot of different impacts or different aspects at play when we talk about valuations, so it's not so straightforward. When we move to the next slide. So then where do we see the need for integration of climate risk into credit risk for commercial real estate? So the simple answer is that it should be incorporated into all aspects. So from setting limits and origination, all the way to modeling risks, so PDs and LGDs. However, all of these aspects really rest on one important aspect, and that is having available to all different parts of risk management good quality and comprehensive data. And this data needs to be everything from EPC ratings to understand the transition risk, data to understand physical risk, and then also data from the borrowers on their ESG profile. And what we did as part of a project, which I'll explain in the next slide. So at the moment, we're carrying out a target review on commercial real estate more broadly. And as part of that, we are investigating the availability of data, or at least how banks are integrating climate risk into their credit risk management practices. And at a very simple level, we collected EPC data from a relatively large, I would say, sample of banks. And what we've learned is really that the data availability is quite poor. So for the total sample, it was about 37% available, but this includes proxies. So in terms of real data, it's quite significantly lower. We discussed this with a lot of the banks in the sample, and there's quite a number of structural issues, particularly for commercial real estate, that makes it quite challenging to collect this data. So the first is quite an obvious one. So in terms of the existing stock of loans, the legal agreements don't actually make provisions for requesting this data or this information from borrowers. So unless the borrower actually wants to provide it, it can be quite challenging to get this information. Some countries have publicly available EPC registers, but this isn't so prevalent. And there's also, I mean, even if the registers are open, there's also some challenges with collecting or with gathering the data from these registers. But in a lot of countries, they actually don't have these registers, which makes it quite complicated you basically have to just rely on the borrower themselves to collect this information. In some cases, what we heard from banks is that it's actually technically quite complicated to calculate or to get an EPC rating in the first place, particularly for shopping centres. And then in terms of the costs for a lot of these buildings or these kind of more complicated buildings, in some cases it can be prohibitively high. And this is particularly an issue where a borrower becomes under financial distress or the cash flow generating capacity of the particular asset is lower or becomes low. Then it's quite difficult to push the borrower into collecting this information or at least obtaining it. And then I think we are all very, very well aware of the last one, which is there's no harmonization of EPC ratings across the EU, which makes collecting the data and actually aggregating it quite complex. So then I think from our perspective and having quite open discussions with banks, on the last slide, you'll see some opportunities for improving the data. And this is where, and these are collected basically from best practices that we've discussed with banks. And the first one is really around, it's very, very straightforward, and it would solve quite a big part of the problem over the next couple of years. If for new lending, this was simply a requirement and it becomes part of kind of the regular everyday credit risk management in the bank. For the stock, it's a little bit more challenging, but certainly banks could include at annual review time as part of their processes to collect this data on a best efforts basis from borrowers directly. And then where the borrowers actually require or request a modification to their loan terms, which does actually require a change to the legal agreement, there is quite a strong opportunity there to collect this information or require it at that point. So similar to what you would do for a new loan. Very specific to commercial real estate then, there as part of the CRR, it's a requirement that for larger buildings, there is an updated independent valuation every 3 years. So at this point, when banks are instructing valuers to carry out the valuation, there's an opportunity to ask the valuers to actually collect this information and provide to the bank as part of the valuation. And then lastly, what we've seen in a smaller number of banks across Europe is that they've actually created incentive schemes to get borrowers to upload data onto public registers, or they've also educated the borrowers around the annual review process about how to actually go about getting an EPC rating on the building. So I will stop there, and thanks a lot for your attention. I'll probably hand back to Carlo or the chair. Thanks.
Thank you, Marie-Therese. Can I just ask one question? I'm thinking about what you're saying, and I totally get the data shortfall problems there. When you think about what's happened in the last couple of years, commercial real estate has fundamentally changed. Lots of banks have lost lots of money lending to the wrong commercial real estate. And who'd have thought 2 years ago lending to Amazon warehouses is the best thing you can do and lending to shopping malls is the worst thing you can do? And I just wonder, with all of those data problems, yes, but isn't there then a second question of how you then apply that to commercial real estate? And I think you can, in climate change, you can talk about flood risk, storm risk, all of those kind of things, but that's presumably more IOPIA's problem than yours. It's an insurance risk. How do you use that data on the banking book to then think about what's the framework for which types of exposure are going to do badly, which types of exposure are going to do well? That's probably a far too big a question.
It is a very large question, so I will just answer a part of it because and relevant to the presentation. So from our perspective, an immediate problem for credit risk is really, or the immediate impact will be on collateral valuations. And there's a wider kind of trend in commercial real estate where office and retail is a little bit of a deteriorating asset class. And what we see is really the demand, and where you see valuation stabilizing is with those assets that are good quality. And I mean energy efficient, A-rated buildings. They're the ones that will maintain their value. The secondary issue then is where the non-energy, or say the less energy efficient buildings are losing value. The only way to improve or stabilize collateral valuations will be to improve the actual energy efficient, or how slick in terms of energy efficiency and IT that these buildings become. But can they actually afford it? And this is the credit issue. Can they actually afford to improve these buildings? Because they won't be able to pass on the rent sufficiently to cover probably the costs that it's going to be. So, and it's just purely transition risk perspective and how the transition risk actually translates into credit risk. It's not even touching on physical risk and how insurance is going to impact. There's so many different elements at play.
So, Marie-Therese, that was a very big question. Like giving you no time at all to answer it. We are kind of running out of time. Suggestion: maybe we ought to be talking to IOPIA in one of these presentations in future. But Carlo, Marie-Therese, thank you so much for the presentation. Thank you to all of the presenters today. I think we've had a very, very clear common theme and quite a nice interrelation between the various presentations. And I guess, if anything, it's saying that all of our conversations that we've been having over these years on these correlations are starting to come into the real world of real regulations and banking supervision. On that positive note, I'm going to hand back to Luca, and thank you everybody again for your participation and for all of the questions. We really appreciate those, even if we don't have time to answer them all.
Thank you, Richard, and thank you to all the speakers. Allow me to conclude with an announcement, in the sense that we are preparing in October the first Energy Efficiency Mortgage Label Committee, which will take place in Venice on the 3rd and the 4th of October. This will be the occasion to invite all the authorities presented today to join us and to discuss together about how to find solutions. In October, we will invite also, we as EMF-ECBC, we are taking over the secretariat of the ESMA organization, which is an international association collecting all the mortgage refinancing companies managed by the World Bank currently, Fannie Mae, Freddie Mac, and all those kind of institutions. And we would like to bring Europe at the center of the global debate about ESG. They will be also invited in Venice at the beginning of October. This will be a fantastic opportunity to share views at the global level. And we would like really to put the effort the European authorities are doing at the center of the stage and trying to build a global, I would say, alignment around the ESG debate. The lesson learned from today. For me, it's very clear that we are in front of a massive strategic challenge for our organization. This is what I will report on Thursday to my board. We need to change the best practices, the business model of our companies in order to support the renovation way. What we should not be doing, I think it's also very clear to me, we should avoid greenwashing by improving access to data, making investment and disclosure for our banks more clear and more harmonized at European level. We should avoid any form of speculation and any form of bubbles or speculative lending, that this will increase actually financial instability. We need to learn the lesson of the last crisis. The banking union, the capital markets union have been very efficacious in addressing the challenge of the previous crisis. We have seen this with COVID. We should continue on this track. Financial stability should be at the center, and I think covered bonds and mortgages have been always at the center of the financial stability heart of the European Union. We will continue to do our job. We will continue to work with all of you and trying to propose solutions. It's a very complex situation. It's very difficult, but we are working all together to build a new ecosystem. And probably in Venice in October, we will be able to present you a new ecosystem, putting together solutions for consumers, for banks, and small, medium enterprises working in the renovation. And we can actually create a system where data can be made available directly from the small medium enterprises working in the renovation to the consumer and to the banks. Like this, the banks can comply with the new rules coming from taxonomy and all the ESG regulation coming. I would like to, with this, conclude, announce you that next Bauhaus will be on the 27th of June, so don't miss it. And I would like to thank again everyone for the lively debate, for the question. And I hope that you are enjoying this kind of event, the Bauhaus, and let's Greenstorm together, like this Lucine. She's the one who invented this term, so let's Greenstorm together. Thank you all, and have a lovely afternoon.